So, as I said at the beginning, I'm a great defender of trade and trade finance. And it's quite interesting. I mean, Eleanor's opening remarks are a sort of, would be depressing if you actually follow the point that in trade finance terms, is fraud on the increase, and therefore are we all doomed that the only transactions we'll ever do are fraudulent ones? And of course, the answer is that the only things that ever hit the headlines and the only things we ever talk about are the frauds. So that there is a huge amount, I would suggest to you, of underlying transactions that are perfectly well dealt with, documented, and performed. But of course, we only hear about the big examples. And of course, one of the reasons we hear about the big examples is that if I was a fraudster, and I hope none of you are in the room, but if you were, if you're going to practice fraud in some way, shape, or form, you're going to do it for large sums of money. So nobody stands up and says, you know, I defrauded TfL out of 10p or whatever it is because I didn't pay my fare. No, so the answer is I used, ironically, some of the best known tactics in order to extract money. In receivable terms, I double funded a receivable, I created non-existent receivables, I performed impersonations, so I pretended to be who I wasn't. And when I got really clever, instead of dealing with receivables, I also managed to do it in commodities. So I double funded commodities, I pretended commodities weren't there, or like Jindal, I created 10 times as many warehouse receipts. Some of you finished up with warehouse receipts that were valuable, some of you clearly got fraudulent ones, and whatever it is, 5 years later, you're still trying to work out who did what. So all in all, these were very much the same frauds, and if I throw out names like First Brands, Artis, Trafigura was deceived about a container load of, well, I don't know actually. But so that we know how they're done, we know what can be done, and then I would slightly disagree because in reality, those are the ways to do it. I mean, they're variations on a theme, but they're ways to do it. So the answer is, what's the solution? And I hope my panelists here are going to give you some ideas. Somebody sent on LinkedIn, digitalization is the solution. Well, team, digitalization is the solution. I don't think so, but it may be part of the solution. So shall we get started? Let's move along the line. Neil, start us off.
Okay. So after the prep call, I realised this week is going to be quite a lot of international trade fraud narrative. So being back home for the first time in a long time, I thought I'd dig down into the UK fraud. And so we did a lot of research recently, my company and I, into this. So I'm going to bamboozle you with the dystopia of the trade finance, the SME lending situation in the UK at the moment, and then we'll talk about the positives after. So here's some statistics. In 2023, I'm going to focus because there's a lot of more holistic statistics around that year. Duplicate financing in the UK reported by lenders was 37% in the UK versus 16% in France. Invoice re-aging, 35% in the UK versus 16% in France. Debtor collusion, 32% in the UK versus 12% in France. I don't know why I'm picking on France, but anyway. Basically across 5 different or 6 different fraud typologies, the UK unfortunately ranks number 1 in all of them. In 2023, from the big 5 banks, lending dropped 18% to SMEs. And the number 1 reason that they gave for that was risk aversion. That was 29.6 billion to 24.3. And the statistic that I find most interesting around 2023, 2024 is the following. SME lending versus a percentage of GDP. So that's to normalise it against market size. Belgium, 29% of outstanding loans to SMEs versus GDP, okay? That's a very high number. France, 23%, Germany was 11, and the UK only 6. That means that at the very least, 1 in 5 small businesses in the UK is getting financing, and obviously these statistics lean towards fraud being a major issue or driver of that. At the very least, fraud is contributing to a larger structural problem for SME finance in the UK. Now, nothing's really changed, and so we'll try and move past the dystopia to the bridge. Nothing's really changed from 2023 to now. The only thing that's kind of come up until very recently is obviously private credit's sort of also been a catalyst or a participant in the SME lending space because the returns were so big. Now, we've all seen what's happened in the last sort of 6 to 9 months. First brands in the US, frauds here. There's going to be a massive withdrawal from the private credit space and obviously retrenchment of that liquidity pool to the SMEs as well. So what does that mean for us here or our businesses back in the UK? There's obviously going to be more of a contraction of lending to the small businesses, and that's not good for anyone that cares about home like we do. So what's the solution in this? Now, in multiple countries, and my business, very lucky to say, has got global perspective. There's around about 30 countries around the world in doing different flavors of the same thing of digital public infrastructure. My company's involved with some we're not, but mostly we have perspective over all of it. The way in which the SME gap is being bridged in almost all of these countries is with centralized repositories to do comparison of risk analytics in a centralized way, often governed or run by a state. And these have been wildly successful. So here's the utopia. In India, since 2023, there's been since January 2023 to March, end of March, a 319% increase in MSME funding because there is sub 1% risk to micro and small business lending. And that's, I have these statistics because my business is that infrastructure. In the same period of time, there has been a 54% increase in financiers providing liquidity. There are banks in this room right now lending to small businesses in India because there's less than 1% fraud, because it's a good return. And we're probably not sending as much of that money, unfortunately, here because there is a much higher percentage of fraud here. Apparently, depending on the metric, it's around about 4 to 6 billion. I would estimate that it would be about 4 times that from the statistics I see in other markets from other sort of centralized repositories. Now, of course, I'm talking about debtor collusion, re-aging of invoices, falsified documentation, and so on. Fraud's obviously often labelled as invoice fraud or trade finance fraud. There are other frauds in the UK which are very relevant as well. So that's application fraud, so falsifying identities, falsified accounting, and these are growing categories here in the UK, which obviously also can be addressed with sort of more digital public infrastructure, be it digital identities, which we probably won't go into today because that's another vortex. And other things. I'm pleased to say that e-invoicing is going to become a thing here, which is really positive for the SME space. And that's a huge leap towards tackling fresh air invoicing, but other things to tackle double funding and other types of fraud typologies are still necessary. And that's because a e-invoicing system doesn't, that's sort of a one-time declaration for tax, and it doesn't validate if it's been financed by someone else or who has security interest or a lien on any one transaction, which is also really important in that space. So anyway, this is more about perspective, what other countries are doing. I hope that the UK banks and industry or ecosystem here today sort of would get behind some sort of infrastructure that would promote more liquidity, because obviously everybody wins there, right? You can lend more, you lose less. You can make more money as a bank. And obviously everybody who cares about the UK ecosystem sees an economic growth like India has seen with those very eye-watering growth statistics. I think that's probably enough from me on the UK.
We'll come back on registries and e-invoicing, I'm sure, David.
Yeah, thanks, Jeff. If I sort of address your first question of can we ever beat the fraudsters, without wanting to start on a negative note, I'm going to say no. Fraud is such a money is such a powerful incentive. Where there's money, there's always going to be fraud. as much as we might hope that, one day our financial controls and our processes will be so good that, the fraudsters around the world will throw their hands up in surrender and say, okay, fine, we'll stop. It's not going to happen. But what we can do is make life difficult for them, and mitigate the risks. And actually, a lot of FIs, already do that, and quite well. As Jeff said, trade finance often gets a bad press, but default rates are pretty low. It's pretty safe in terms of the full spectrum of banking instruments. But at the same time, there is no room for complacency. The regulators are increasingly focused on it. There's a reputational issues of your name in the paper alongside these fraud cases. So there is a real reason for sort of not dropping the ball, so to speak. In terms of, I think, the best way to, or a solution, if you like, I've got two that sort of immediately spring to mind. And the first is regular reviews of both your clients, but also your internal frameworks, your appetite for risk, the way your internal controls work. Because things do change, circumstances change, the world now is a very different place, geopolitically, for example, from 3 years ago. And these are the things that sort of inertia, or inertia creates problems down the line. I mean, to give you an example, so last year I was speaking to a bank and just in, sort of conversation, and they mentioned that, in the absence of any adverse information, they will only conduct sort of fresh KYC or due diligence on their clients, on low to medium risk clients, about every 3 years. And I sort of mentioned that's quite a long time for clients you've designated as medium risk. But the response was, well, that's just the way we do it. That's the way we've always done it. And it's not, reassessing these frameworks or these processes in response to, a fairly fluid trade environment that poses a danger. The FCA published something a couple of weeks ago. It was a multi-firm review that again singled out the importance of, regular reviews of systems, processes, clients, because, things change. And going on to the modus operandi of fraud, the methodology, as we said, doesn't change. It's fake documents, multiple financing, misappropriation, etc. But the typologies do, the way it's dressed up, if you like. So in another example, this was a conversation with a central bank, and to give you the background to it, we flagged up one of the domestic bank's transactions as problematic. The shipments hadn't taken place. The documentation was, farcical, I think, to say nicely. And we flagged it up, and they'd escalated it to the central bank, and we had a call with the central bank so they could sort of try and get to grips with what the problem is. And it was a Teams call. The representative was showing their screen, and he had a vessel tracking website up. And he was saying, well, how can you say the shipment hasn't taken place? I can see that the vessel has gone from A to B. So what do you mean it hasn't taken place? And it was just about describing or explaining that those phantom ship type frauds where the vessel doesn't exist or was in the wrong place, those are 20 years ago. The frauds now are, far more nuanced, as we see with the ones that have, come to light in the media. It's not about just making sure a vessel's gone where it's meant to, or that a cargo's on board. It's about the documentation within supply chain finance. It's, is your client or their client, do they have a role in it, or is it a complete misappropriation? So KYC and KYCC to an extent, but really this regular review to make sure, what you do, your appetite to risk, the clients you have, where they operate, what they trade, is all within your tolerance, because, things do move. And I think the last one really is a multi-layered approach to compliance. As much as I'd like to say otherwise, there's no one solution or one product that's going to guard you against all types of financial crime. You need a number of different items in the compliance toolbox, so to speak, depending on what you want to check. And the reason for it is you don't really want compliance to end up as a box ticking exercise, because it doesn't really get you anywhere. It's got to be meaningful checks. Asking yourself, what do I want to check, and how am I going to go about it to make it worthwhile? Because once you break it down to box ticking, you do miss a lot. And I think very lastly, with one final example, once you have your established processes, make sure everyone knows exactly what their role is in it. So in a conversation with another bank, and they're not in this room, I've checked, They sent us a bill of lading for a shipment, and again, it was rubbish, completely farcical, complete fabrication, and we told the bank this. Didn't hear anything more, and then about a month later, we got a very angry phone call to say, well, that was a complete fraud. Why didn't you tell us? I said, well, we did tell you. Anyway, it turns out that the compliance analyst was told to send the documents to the RMB to be checked, but wasn't told to wait for the reply or to read it. So he sent them to us, immediately moved the transaction on to the next stage of processing. The next stage saw it come from compliance with no red flags, no notes, and passed it through. So I appreciate this is a bit of a far-fetched example, but everyone has to make sure they know exactly what their roles and responsibilities are within your framework, which you review regularly. I think that's sort of about covers it.
I'm going to come back to you a bit on fraud if you get time.
Yeah, sure.
On that. Anitra, you're going to talk about insurance.
Yes, I'm going to talk about insurance, but before that, a little bit of context. So we have seen a shift in conversations with our banking clients, just because the focus is no longer just trade credit risk, but is also the quality of the underlying data, right? So the question has moved from will my counterparty pay to can I trust what I am financing? Are the documents real? Are the receivables even existing? Are they going to behave as we expect them to, right? And this shift is critical because for banks, fraud is not longer an operational issue, but it's a balance sheet risk. So when fraud happens, it can really be contained. And when controls fail and the fraud is identified, then the loss is already there. And that's why our banking clients think of insurance as the last line of defense that can work where everything else have not worked before, right? And this is even more important today just because of the macroeconomic environment that we are living in. Liquidity is tighter, margins are under pressure, and the incentives to stretch working capital are increasing. Therefore, the banks no longer think as fraud as a hypothetical risk. It has not been hypothetical for years and is a real risk. However, when we go into the insurance market trying to cover this, not only seller fraud but debtor fraud, we face a limitation because traditional trade credit insurance do not cover fraud. If we are thinking in a receivables transaction, the typical wording says something around any receivable arising from a fraudulent setup, whoever party has initiated, so this means seller fraud and debtor fraud, is actually out of the scope and is not included in the cover. It's true that banks usually try to negotiate some sort of flexibility around that clause. So if they didn't knew about it, if they were not involved in the fraud, but usually traditional trade credit insurers do not grant that flexibility, and the bank remains with the risk. And this is why it's important for me today to discuss another solution that we are seeing in the market that can cover this gap. This is not new because it has been used in the US market for several years now, but is gaining traction among the European banks. And it is seller cover or insurance solutions that can cover seller risk. And what it does is simple. If we are thinking in a factoring transaction, the question is no longer have the buyer paid, but has the seller honored its obligations under the financing agreement. So instead of insuring the asset, instead of insuring the underlying receivable, we are now insuring seller's behavior. And this is completely important in factoring transactions because banks rely heavily on seller data, right, and its servicing. So to put it in more simple words, what this type of policy can do, it can cover anything that the bank has a repurchase agreement to the seller under the RPA, or the receivables purchase agreement, or any type of recourse. So, for example, we are thinking disputes, we are thinking commingling risk, we are thinking ineligible receivables. And this is why it is important here today, because we are also thinking fraud. Not only seller fraud, as we are ensuring seller's behavior, but also debtor fraud. It can also cover the recourse to the seller for the uninsured part. So if we are thinking of a limited recourse financing structure, the bank usually have this recourse for the 5-10% that is not insured, and this solution can also cover that. Having said this, the seller cover is not a blank check and is not a substitute for discipline, because at the end of the day, controls still matter and governance still matter, and the policy has some exclusions. So if the bank knew about it, then there is no claim. If the bank has waived its rights, then there is no claim. If the obligation was not legally enforceable, then there is no claim. Right? So governance still matters, but it is true that it's a way to reallocate the risk. And before concluding, just to finalize, this is not the only solutions that we are seeing in the insurance market. There are others out there that can cover debtor fraud, but there are needs and specifically for certain type of portfolios. So they are not something that can be broadly applicable to all of the trade finance portfolios. And to finalize and to try to answer the question, can we beat all fraudsters or can we beat fraudsters? My reply as an insurance broker would be no, and then it comes the punch, but no, realistically not all. Fraud will continue to evolve, and then controls will continue to fail. But the real question is who will bear the loss when this happens, and in my case, we are also recommending insurance solutions just because it can help transfer the risk. So at the end of the day, it's not the bank or the non-banking financial institutions who need to bear that risk. Thank you.
Very, very interesting. Again, we'll come back because, of course, asking financiers to take seller risk, essentially, to analyse seller risk, is contrary to what most of them want to do, which is they only want to analyse finance.
Yeah.
Robert, legal
Thanks.
solutions?
Well, first of all, the question, can we beat the fraudsters? The answer is, most of the time, yes. Will we beat all fraudsters? As David said, no, because the human mind's ingenious and cash is a huge incentive. I think it's worth just saying at the beginning that international trade, in the high 90% of it, pays out. It's not subject to fraud. We have great transactions which are carried through. Why? Because lots of people involved in the business take the precautions to make sure they're not going to be caught. It's one of the things that is very apparent when you look at any kind of crime, is that you're more likely to be the victim of crime as a result of the actions of someone you already know. Unless you're in the habit of walking through the West End of London flashing a Rolex watch on your wrist and a t-shirt late at night, it's probably unlikely you'll be the victim of a mugging walking home tonight, even though there's a tube strike on and there's more opportunity for muggers. The fact of the matter is that most transactions are fraud-free, and most fraud is ultimately committed by people you already know. So know your customer, KYC, is KYF, know your fraudster. The reality is that if you know your customer well, your transaction well, and you've got the nuts and bolts of it right, you'll prevent fraud at the application stage, because actually it's the opportunity for fraud that's produced at that early stage that will catch you out. And when we're looking at those basics, and some of it you've heard from the panelists already, knowing about the existence of the supply chain, the history, my reputation of the trading that is done by the party that you're financing, and understanding how to work out whether goods exist, services exist, invoices exist, are all part of the basics that you do. And the legal toolbox that you use to make sure that that due diligence hasn't gone to waste isn't just a lot of boring stuff that you raise your eyebrows when you hear Jeff or I saying, look, we really do need to make sure that we hammer down on this covenant or that rep or that trigger. they're there for a reason. They're there because it makes you easier to spot the kind of fraud that is likely to occur. And a very large percentage of those, and I'll give you some examples in a minute of the recent ones, are ones which are what I would call end-of-life survival fraud. They're not actually companies that were set up to fraud. There are some great celebrated examples of that, of course, and we've seen some of those. I'm not referring to any of the names that have been mentioned already today, but in practice, most of those frauds happen because there was the chance to do it. Circumstances dictated that to survive, to pay the wage bill next week, to put the fuel in the private jet the following week, all required the fraud to be carried out. And so those are the things that actually set the scene. They enable fraud. And I think if you look at the kinds of fraud that have been committed, I've just made some sort of notes here of what's happened just during the last 3 or 4 years. We can talk about the 2019, 2020 frauds, but I think a lot of those were tainted by an opportunity that COVID and other circumstances brought into the market. But look at what's happened over the last few years. The TMT metals fraud, which Jeff alluded to earlier on, and it was meant to be nickel in those containers, but was a mixture of whatever, builder's rubble and various bits of scrap. That resulted in a $600 million loss for Trafigura. The Vestu fraud, interesting one, because that was actually forged letters of credit, not something you see all that often. The victims of that, sadly, and I spent 13 years as a partner in an insurance defense firm, most of the victims of that were insurers. Clearblue, Beazley, Markel, the LCs were set up to pay for premiums and cover runoff losses, and they turned out to be non-existent. So it just shows you, even the people who are the most wily and careful, and of course, the first people to claim fraud when there's a loss, get caught out. First Brands, $2.7 billion, a host of people caught out with that. Fabricated invoices, inflated invoice values, pledging the same receivables to multiple lenders, all things we've seen over our lengthy careers. I think that's one of the things that people forget is that if you hire the people who are populating your front and middle office from Cranfield Business School over the last 5 years, the chances are they wouldn't have seen all of the things, Solo Industries and the rest of the scams that have happened down the years. And the reality is there's a lot of repetition. Trickler, $800 million. JP Morgan, Barclays, Fifth Third Bangkok, fake loans, double pledging of collateral. So all of these are things which result not from someone parachuting from the internet, but these were businesses that were running for some considerable time, running profitably at one stage, then running not so profitably. And the result was that at the end, fraud was there as an opportunity. Why? Because of course people slacken off, they get comfortable with the people they're dealing with. The guy that defrauded you was probably the person you invited to dinner 3 weeks ago. You played golf with him on Wednesday, and on Friday he defrauded you. That's simply the way that fraud manifests itself. So how do you avoid that? What's the fraud prevention detection kit? Well, I'm not going to surprise you with anything that I'm going to say now, but all of those things, setting up the legal agreements to have triggers that work, that are not there simply for show, boilerplate. They're there to make sure that if something goes wrong, behavior changes, you spot it. So great pre-funding credit analysis is obviously the core of all of those things. Thorough KYC, AML checks. Does fraud go unreported? You bet it does. Fraud goes unreported because if fraud exists in a medium of money laundering or some other infringement, there's probably less incentive, unless it's life-threatening to the organisation that suffered it, to go and report it and blab about it publicly. So yes, there's underreporting. Customer visits and visit them again. And I know that Peter and I were reminiscing about the first fraud that he and I were involved with, and it's about 30 odd years ago now, but it involved someone turning up to look at a warehouse which should have had very large numbers of bags of coffee in East Africa. And they turned up, the labels were on the right bags, and we scratched our heads and we said, I'll tell you what, go back again tomorrow. And of course, they turned up again the next day and there were a different bunch of bank labels on the coffee. And so, visit again. Ongoing credit monitoring. Choose the right software. Lots of options available. Everyone's selling something. Some of them are in the room right now. But work out what it's going to do for you in the context of the kind of business that you're running. Not going to be the right for everyone. Use technology, digital trade, stock recording. There are some fantastic innovations that are out there. Market reality. Does the business that your customer, your borrower, say is doing match up to what you're seeing in the market? It's not, these things aren't happening in a vacuum. Thoughtful financial covenant triggers, as I've said, important that you use those. Use what's in that legal toolbox effectively. They're there for a reason. Physical trade checks, locations, do the logistics sound right? Is the shipping route one that's sensible? I know there's lots of discussion about this. I was doing an interview recently about the extent to which the current conflicts are going to mean that things are rerouted. Suez Canal may not be viable any moment now with people shooting off armaments from Yemen. But even so, are the routes that are being suggested sensible? Do they work? And finally, behavioural changes in the way that your customer is working. Ask questions. As Ted Lasso said, be curious. I think that's the gist of it.
Sign off, be curious. So the conclusions from all of you is all the frauds that we've talked about were detectable. So there was no surprise. If you'd done what was being said, and I was talking to a client last week, the First Brands as an example, if First Brands was such a quality towards the end, why were the margins being offered to funders something like 7% when they should have offered 1%?